Of all the things that are important to mall owners and shopping center operators, which one is the most important? Foot traffic generated by movies, which seems to me to be rather an incremental thing, the overall health of the consumer, or third, the level of interest rates?
Well, first of all, thanks for having me back on the program. Great to be with you. It's really all three factors that you just named, in that the consumer strength and confidence has to be there. We're seeing record consumer demand and record retailer demand for brick and mortar retail in the last 20 years. We have not seen this much demand for leased space, expansion space, and renewals than we're seeing today by a variety of tenants. That's because
Let me interrupt you if I might. Let me interrupt you if I might, Hassan, because I'm curious about that. Is that demand in certain classes of malls more than in others? Because, boy, I see an awful lot of strip malls that look like they are about to go out.
To your point, there are plenty of retail that's still hurting.
Yep.
Especially the lower end retail, the older retail that has not benefited from what is now considered the most important factor behind that broader consumer strength, and that is experiential retail. Food, fitness, and fun are the three drivers of the renewal of retail, contrasted with 20 plus years of no new construction by any large measurement and demolition of a lot of retail. Some of the retail with dark spaces you're referring to will be reused or re-tenanted. It's going to take time. There's still pain playing out. But much of that pain is behind us because retail was ahead of the curve because of e-commerce in renovating and adjusting to a new economy. We're seeing this record demand across different retailers, both value retailers for the lower end, lower income consumer, and of course the higher end consumer and everything in between. Movie theaters and other forms of entertainment are a major driver. Restaurant and bars are the most important. Their sales way outstrip grocery sales now, which is really interesting. And post-pandemic, people have been so eager to get out and experience different things, including movies, by the way. We're somewhere between 20 to 30% below where we were pre-pandemic by multiple metrics, but it's coming back fairly strongly and fairly steadily. And theaters are very hard to reuse, very expensive to recycle. So owners are working with theater tenants on this reinvention that we're seeing in the theater space, as well as multiple other aspects of retail.
And Tim, I'm glad that Paul mentioned the strike impact. I forgot we were in this massive strike last year. It's delayed some of the content into now 2025. So maybe that's a hopeful note. If you're an investor, do you try to pick up some of the mall stocks, so to speak, on the cheap if they are on the cheap just because of this one unique phenomenon, or do you worry about the consumer more broadly?
I don't know how cheap they are. And if you think about Simon Property, they just had numbers. By the way, their numbers were fine. I mean, and their lease rate, they're 95.5. They're up 110 bips year over year. I think malls' biggest problem are malls. And ultimately, I still think there are headwinds there. Some of the discretionary kind of flags that are planted in terms of the foundation. I mean, restaurants and bars, great. They've had a tremendous run, but all we keep hearing is that there is some pressure from the consumer. But look, I look at a Simon Property. It's near the top end of a one-year range. This is probably as blue chip as you get. And there's no sign that CRE, again, a year ago, we were just fresh off of SVB, et cetera, et cetera. Right now, that CRE element of especially the blue chip mall operators is not a concern for investors. It's more interest rate sensitivity, but rates are up 50 bips this year, and Simon's up 4%.